A few weeks back, I did an episode on 4 research papers in finance which you must read. And honestly, I didn't expect people to like it. Because who wants to read research papers after all, other than a few odd folks like me? But I was thoroughly surprised and overwhelmed by the response. So here is part 2. In the last episode, we looked at 4 papers which talk about, in a way, the architecture of stock markets. Moskowitz on diversification and portfolio construction, Sharp on systematic risk and beta, Pharma on market efficiency and why beating the market is harder than it looks, and Pharma in French on why size and value explain stock returns far better than beta ever did. Today, I want to answer a question which in a way challenges all of that. So through some papers, I will ask, are there cracks within this architecture which we built last time? Are there ways to generate returns above what the market would give you as a baseline? That is what we will explore today. We will look at papers which ask whether there are structural edges in the markets and how to exploit them. And before we get into the papers, we will also take a moment to understand what alpha actually means, because it is one of those words which gets thrown around a lot and not always correctly. So 4 papers, 4 edges. And if you trade or invest in any market, including ours, at least one of them is probably already inside your trading system, whether you know it or not. I'm your host Sandeep Rao, and these are 4 research papers on generating alpha. Before we get into the 4 papers, let me explain for a moment the concept and the word that gets thrown around constantly in markets, alpha. Everyone claims to generate alpha, fund managers, traders, and fin influencers as well. But what does it actually mean? You see, the word comes from a 1968 paper by Michael Jensen titled The Performance of Mutual Funds in the Period 1945 to 1964, published in the Journal of Finance. Jensen was trying to ask the question, do professional fund managers actually add any value? Do they earn returns above and beyond what you would expect given the risks they are taking? To answer that, he needed a way to measure what the expected return should be given the market risk the fund was carrying. So he used Sharpe's CAPM for that. And the difference between what a fund actually returned and what CAPM said it should have returned given its beta is what he called alpha. Alpha in its simplest form is this: return that cannot be explained by the risk you took. Now take this example. If the market gave you 12% and your portfolio also gave you 12%, but your portfolio had twice the beta, you didn't generate alpha. You just took more risk and you got paid for it, exactly as Sharpe's model would predict. But if your portfolio gave you 15% with the same beta as the market, that extra 3% is alpha. Return that came from something other than just taking market risk. Now here is what Jensen found, and he ran the numbers on US mutual funds at that time. Most of them had negative alpha. After fees and costs, professional fund managers were adding no value. They were in fact destroying value. His conclusion was that fund managers do not appear to have any significant forecasting ability. That finding was uncomfortable and shocking when it came out in 1968. And trust me, nothing much seems to have changed in the 60-odd years since. But it sets up an important question for the rest of this episode. If most people cannot generate alpha, if even professional fund managers fail at it, does genuine systematic alpha exist at all? And if it does, where does it come from? The 4 papers we are going to look at today each give a different answer to that question. Let's start with the first one. The first paper is titled Does Stock Market Overreact? By Werner de Bondt and Richard Thaler, published in 1985 in the Journal of Finance. Before we get into the paper, let me explain the concept of mean reversion here because it is the central idea here. I have also done a video which explains the concept in great detail. So in simple terms, mean reversion is the tendency of something that has moved far away from its average to eventually come back towards it. In markets, it means assets which have risen far above their historical levels tend to fall, and assets that have fallen far below tend to recover. What goes too far in one direction eventually gets pulled back. That's the idea. John Bogle, the founder of Vanguard and one of the greatest finance visionaries of the 20th century, called reversion to mean the iron rule of markets. But Bondt and Thaler asked a very specific question in their paper. Does this iron rule show up in individual stocks, and does it happen because investors tend to overreact? To test this, they took NYSE stocks going all the way back to 1926 and sorted them into two groups or two portfolios. The biggest winners over the past 3 to 5 years and the biggest losers in another. Then they watched what happened over the next 3 years to both the portfolios. The results were striking. As they write in the paper, consistent with the overreaction hypothesis, portfolios of prior losers are found to outperform prior winners. 36 months after portfolio formation, the losing stocks had earned about 25% more than the winners, even though the winners had more beta risk compared to the losing stocks. Now think about what that means. The stocks that everyone had given up on, the ones that had fallen the hardest, went on to outperform the ones that had risen the most. The market had overreacted in both directions. Investors had become too pessimistic about the losers and too optimistic about the winners. And over time, prices snapped back in the opposite direction. This connects directly to what Benjamin Graham observed decades earlier, that in the short run, the market is a voting machine, but in the long run, it is a weighing machine. The second paper in the episode is titled Returns to Buying Winners and Selling Losers by Jegadeesh and Sheridan Titman, published in 1993 in the Journal of Finance. Now, if you were paying close attention to the last paper, something should feel off with this one. Bondt and Thaler just told us losers beat winners as they mean revert. And now, Jegadeesh and Titman are telling us to buy winners and sell losers. So what's going on? The answer is time horizon. Mean reversion works over long time horizons, 3 to 5 years, and Bondt and Thaler tested that. But over shorter horizons, 3 to 12 months, the opposite happens. Winners keep winning and losers keep losing. That tendency for a trend to persist over the medium term is what is called momentum. Jegadeesh and Titman set out to measure it. They took US stocks from 1965 to 1989, ranked them by their returns over the past 3 to 12 months, bought all the top performers and sold the bottom ones and held them for a few months. The winners kept winning and the losers kept losing. Their baseline strategy was a long-short strategy to rank on the past 6 months, hold for another 6 months. It earned a compounded excess return of around 12% per year. And this wasn't just a case of taking on more risk to get paid more. The winners minus losers portfolio actually carried a slightly negative beta, meaning it didn't move much with the markets. They write in the paper that part of the abnormal return generated in the first year after the portfolio formation dissipates in the following 2 years. In other words, the momentum edge shows up over months and then it fades over years, exactly as the stock reverts. So yes, both papers are right. Over months, prices trend. Over years, they snap back. Bondt and Thaler caught the weighing machine. Jegadeesh and Titman caught the voting machine. And that brings us to the third paper in this episode. Expected Option Returns by Joshua Coval and Tyler Shumway, published in 2001 in the Journal of Finance. So far, both our papers have been about stocks. This one is about options, and it uncovers an edge that a lot of us are probably already trading. Let me explain. When you buy an option, you pay a premium. When you sell one, you collect premium. The question Coval and Shumway asked is a fairly simple one. On an average, over the long run, do option buyers actually make money for the risk they take? Or do the sellers have a better edge? To test it, they went to S&P 500 and S&P 100 index options and did something very interesting. They built what is called a zero beta straddle, buying calls and puts together in a mix designed to strip out any bet on the market direction. You do that by constantly rebalancing or recentering the straddle. What is left is a pure bet on volatility. If options were priced fairly, that position should earn roughly the risk-free rate, and it didn't. As they write in the paper, at-the-money straddle positions produce average losses of approximately 3% per week. Now read that again. Minus 3% a week on a position with no directional risk whatsoever. That is the buyer's loss, and that is the seller's or the option writer's gains. The person on the other side collecting the premium, the option writer, was systematically getting paid. And here is the why. Options are, in a way, insurance. When you sell a straddle, you are selling insurance against volatility. And insurance, on an average, is priced so that seller profits because buyers are willing to overpay for protection. Coval and Shumway put a number on that overpayment. But as we all know, that premium is compensation for some real risk. The straddle seller collects small amounts week after week and then loses a chunk of it when volatility explodes. As they say, selling volatility is picking up coins in front of a steamroller. The edge is real, so is the steamroller. The fourth and the final paper is Time Series Momentum by Tobias Moskowitz, Yao Hua Oi and Lasse Heye Pedersen, published in 2012 in the Journal of Financial Economics. Remember the paper on momentum by Jegadeesh and Titman from earlier? Their momentum was cross-sectional, buy the winners relative to their peers and sell losers. You were always comparing stocks against each other. This paper asks a related but slightly different question. Forget the peers, just look at an asset's own past return. If it has been going up, does it keep going up? The answer across almost every market they could find was yes. They took 58 of the most liquid futures contracts in the world, commodities, currencies, bonds, equity indices, over more than 25 years. For each one, they used a very simple rule. If the past 12-month return was positive, go long. If negative, go short. That's it. They found time series momentum profits are positive not just on average across these assets, but for every asset contract they examined, all 58 of them, every single one. Gold, the yen, bond futures, the S&P, the same trend effect showed up, persisting for about a year and then partially reversing. A diversified basket of these trend strategies earned a sharp ratio above 1, roughly 2.5 times that of the stock market itself. And there's one more finding in the paper that ties this whole episode together. The strategy performed best when markets were at their most extreme. That is, when the biggest up moves happen and the biggest down moves happen. That's why they say trend-following strategies capture what's called crisis alpha, a term coined by Catherine Kaminsky. So here's a quick summary of what we covered today. We did 4 papers and 4 types of edges. Mean reversion over years, momentum over months, a premium for selling volatility, and trend following across assets. Obviously, none of them is a free lunch. Each one comes with real risk. But each one of them is a genuine crack in the idea that markets are perfectly efficient. And if you trade or invest in any market, including ours, most of them work in some form or the other. It's for you to find out the how. And that brings me to the end of this episode on key research papers, part 2 of it that is. I hope you found this episode useful. If you have any questions, feel free to drop them in the comments. I'll be happy to respond. Till then, take care and trade safe. I'll be back soon with the next one.